What's the best month to buy stocks if you're keen to dabble in the stock market? It's January in the US markets. This is because of a phenomenon called the January effect. So what is the January effect? Typically, in the month of January, stock prices in the US markets tend to close in positive territory. So investors believe that by taking positions in January, you can always make a gain in the market. It's because in the US markets, stocks have generally tended to close in positive territory in the month of January. Curious why this happens? This is because institutional investors like pension funds, mutual funds, insurers and others like to wipe their slate clean in the month of January and restart on their allocations for the year. So even if they've made certain mistakes in the previous year, they like to close out those positions in December and again restart the process of investments. Therefore, if institutional investors are buying, that tends to prop up stock prices. Therefore, if investors follow suit, they too end up making money. A study by CNBC of the US markets between the years 1980 and 2014 based on monthly returns showed that on an average in January the stock market rose 0.92% in the month of January. Therefore, if you took positions at the beginning of the month, you ended up making this gain always in January. Other phenomenon which was noticed in this period was that small cap stocks usually did better than the index stocks or large cap stocks. This is because small cap stock prices usually are more influenced by institutional buying. It's not as simple as that because of the efficient market theory. If you studied about the efficient market theory, you'll know that any information that is available in the market for a certain period of time will get factored into stock prices pretty soon. So if all investors are aware of the January effect, can you imagine what will happen? Everybody will want to take positions in stocks before January. Therefore, the whole January effect gets shifted a bit and everybody is into the stock market in December. Therefore, the positive returns that you can expect in January tend to wane away. This is what has happened in the US markets also. If you see, over a 35-year period, January effect has held good, but in the last 10 years or so, the kind of stock market returns that they've made in the US in the month of January have actually tended to wane. Not really. There was this belief that in the Indian markets, it is the month of December where you make a lot of returns. This was because FIIs or foreign institutional investors are such a big influence on Indian stock prices. So typically at the end of December, insurers, pension funds, hedge funds and others take stock of their annual performance. Therefore, if their portfolio values or NAVs look good at the end of December, it makes their entire yearly performance look very good. Therefore, there was this belief that in order to window dress their accounts, many of these investors tend to do a lot of buying in the month of December. So should you skip the January effect and buy in December instead? Not really. Remember the efficient market theory. If everybody knows about the December effect, it's already in the price, so it's not going to work for you.